Let's jump right into the July 5th, 2026 market landscape. We're looking at a massive tug of war right now, where the global economy is somehow slamming the brakes and hitting the gas at the exact same time. It's a wildly divergent environment out there, so let's break down exactly what's happening. To make sense of this, we're going to run through 5 key areas today. 1. The global economy's cooling act. 2. U.S. jobs and central banks. 3. The AI reality check. 4. A massive currency clash driven by the strong dollar. And 5. Oil's retreat and whether there's relief ahead.
Starting with Section 1. Global economy, a cooling act driven by World Bank downgrades.
So the World Bank just slashed global growth projections to a pretty sluggish 2.5% for 2026. For context, we were at 2.9% back in 2025. The main culprit here? Ongoing geopolitical friction in the Middle East is really dragging things down. But here's where it gets complicated. Slow growth is only half the story.
Check out this tension. Even with growth cooling off, global inflation is stubbornly stuck at an anticipated 4.0% average for the year. Why? Basically, we're still dealing with the hangover from earlier energy and fertilizer shocks. So we're caught in this nasty trap of slow growth and sticky inflation, which puts a ton of pressure on central banks.
Which brings us to Section 2. U.S. jobs and central banks and their totally divergent responses.
The U.S. labor market is noticeably cooling. Just before the holiday weekend, we got a surprisingly soft non-farm payrolls report, only 57,000 jobs added, pushing the unemployment rate up to 4.2%. Now, normally that kind of miss would spark panic, but markets are actually taking it as a win.
And that's because of how the Fed is reacting compared to everyone else. That soft jobs print actually eases fears that the Federal Reserve is going to aggressively hike rates anytime soon, which gave U.S. equities a nice little cushion. But look overseas. The European Central Bank and the Bank of Japan, they are doing the exact opposite. They're making hawkish pivots and tightening policy to fight their own sticky domestic inflation. The Fed gets a breather, while Europe and Japan have to tighten the screws.
Moving on to Section 3. The AI reality check, focusing on tech volatility and supply chains. This is a fascinating domino effect that proves digital revolutions are still totally bound by physical reality. It started with maritime transit issues, which actually caused a major helium shortage. No helium means chip manufacturing gets constrained, so chip prices spike. That makes running AI models insanely expensive, leading to massive computing token bills for corporate clients. And the result? Those clients are suddenly putting hard usage caps on their AI enterprise services.
Those corporate budget caps threw some ice water on pure-play AI valuations. We saw a brutal midweek sell-off where major semiconductor stocks tanked 10% in a single day. Obviously, part of that was investors cashing in on massive Q2 gains, but it's a perfect example of what happens when sky-high AI hype collides with actual infrastructure bottlenecks.
But the tech sector is totally split right now. While those pure-play chip makers dropped 10%, Meta actually surged nearly 9% late in the week. The catalyst? Reports that Meta is planning to jump into the cloud business to directly sell AI computing power. Investors are clearly realizing that whoever controls the actual compute power can bypass those hardware bottlenecks and win big.
Let's look at Section 4, Currency Clash, the strong dollar and its global collateral damage. The U.S. dollar is acting like a wrecking ball right now, hitting multi-decade highs against the Japanese yen. It's getting so extreme that there are widespread fears Tokyo is going to be forced into direct market intervention, meaning the Bank of Japan would literally have to step in and buy yen just to stop the bleeding. And Japan's not alone here. The South Korean won plummeted almost 6% against the dollar in the first half of the year. This directly tracks with massive foreign stock sell-offs in emerging market tech and autos. When investors flee to the safety and yield of the U.S. dollar, these local currencies just take an absolute beating.
Finally, Section 5. Oil's retreat and some potential relief ahead.
We are finally seeing some relief in the commodities market. Both WTI and Brent crude futures have drifted lower, trading down into that $67 to $68 a barrel range. Market participants are basically reacting to cooling geopolitical rhetoric and a really steady flow of global energy supplies. And honestly, with global inflation stuck at 4%, cheaper energy is exactly what we need to keep the economy from stalling out completely.
So, to wrap this explainer up, I want you to think about this. We've got physical bottlenecks like helium shortages, literally capping AI growth. We've got the global economy cooling, while the US dollar and certain tech giants heat up.
With all these massive, conflicting forces pulling the market in opposite directions, where is the next great divergence going to take us? Keep a close eye on those supply chains and central bank moves. Thanks for diving in, and I'll catch you next time.